Hello and welcome to Ticker Tapes. Today, we're back in the world of ETFs. Bonds are back, or at least they were with ETF investors who plowed more than $7.5 billion in the asset class last week. The biggest winner was the iShares 7 to 10 year Treasury Bond ETF, IEF, which picked $2.82 billion of new cash, a figure that represents almost half of the year-to-date inflows into the fund. Overall, the fund has some $22.4 billion of assets under management, so it effectively enjoyed a 10% boost over the last week. Performance-wise, the ETF's price has dropped by 10.84% year-to-date. Other bond-related ETFs that saw an inflow of cash over the last week include SPTI, the Spider Portfolio Intermediate Term Treasury ETF, which added $1.6 billion, HYG, the iShares iBox USD High Yield Corporate Bond ETF, saw inflows of $1.39 billion, and USFR, the Wisdom Tree Floating Rate Treasury Fund, picked up $606 million. Bonds and bond ETFs might be seen as being more attractive if U.S. interest rates top out around 3.5% over the next 6 months, especially if the U.S. avoids a recession and has a soft rather than hard landing as the economy cools from its post-COVID peaks. However, if interest rates climb farther and faster than anticipated, then in theory, bond prices will fall once more. We saw divergence amongst energy ETFs over the last week, with natural gas prices climbing as higher temperatures encouraged consumers and businesses to turn to their fans and air conditioning, moves which increase the demand for electricity, much of which is generated by gas-fired power stations. At the same time, however, oil prices retreated on concerns about further lockdowns in China and slowing global demand. This chart of the USO, the U.S. Oil ETF, and UNG, the U.S. Nat Gas ETF, in red, highlights the differing price action between the pair over the last week. It wasn't just U.S. natural gas prices that moved higher. Those in the UK and Europe also edged up as Russia closed its Nord Stream 1 gas pipeline for essential maintenance. There was a sharp jump in the volumes traded in the merger ETF, MRGR. The fund, which is managed by ProShares, tracks a basket of developed market stocks that are engaged in M&A activity. The daily average volume in the fund runs at just over 69,000 shares. However, almost 1.2 million changed hands on Tuesday this week. Year-to-date, performance in the fund has been mixed, and it's down by 4.1%, though that compares favorably to a 12.87% drop in the price of SPY, the S&P 500 tracker, and a 28% fall in the price of QQQ, the ETF that tracks the NASDAQ 100 index. So far in 2022, we have seen global M&A activity that is valued at a little over $2.2 trillion, and there have been 2,274 deals, but both numbers are down on the corresponding figures for 2021. However, with many technology and growth stocks suffering significant falls, there may be bargains out there for large cap predators or private equity funds that still seem to be chock full of cash.